Let's face it, investing can be nerve-wracking enough without worrying about the stability of the platform holding your nest egg. Today, we're diving deep into a question that keeps many Canadian investors up at night. What happens if Wealthsimple goes out of business? Now, before we hit the panic button, let's take a deep breath and unpack this situation. Wealthsimple has become a popular choice for Canadians looking to invest, but with its rise in popularity comes natural concerns. So, buckle up as we explore what safeguards are in place and what to expect in the unlikely scenario of Wealthsimple shutting down. First things first, it's important to understand how Wealthsimple holds your investments. They don't actually own your stocks, bonds, or ETFs. Instead, these assets are held in trust for you by a separate custodian, kind of like a safe deposit box at a bank. This custodian, Wealthsimple Investments Incorporated, WSI, is a crucial player in this story. Here's where things get interesting. WSI is a member of the Canadian Investor Protection Fund, also known as CIPF. This government-backed organization acts as a safety net for investors in case their brokerage goes bust. CIPF coverage protects your cash and securities like stocks and bonds, up to a limit of $1 million CAD per account type. So, if Wealthsimple were to face financial difficulties, your investments wouldn't disappear into thin air. CIPF would step in and ensure you can transfer your assets to another brokerage or hold them with WSI, even if Wealthsimple itself ceases to operate. Now, this protection applies to your investment accounts, like Wealthsimple Trade and Managed Investing. But what about your cash? Wealthsimple also offers cash and save accounts. These accounts function differently. Here, your money isn't held directly by Wealthsimple. Instead, it's parked with their partner institutions, major Canadian banks that are members of the Canada Deposit Insurance Corporation, CDIC. CDIC plays a similar role to CIPF, but for cash deposits. If a CDIC member bank were to fail, your cash would be insured for up to $100,000 CAD per account type. Wealthsimple cleverly partners with multiple CDIC members, allowing you to spread your cash across these institutions to potentially maximize your coverage up to a combined limit. Phew, that's a lot to unpack. But here's the gist: CIPF safeguards your investments, and CDIC protects your cash, both up to specific limits. So, while Wealthsimple going under wouldn't be ideal, there are mechanisms in place to protect your hard-earned money. Important caveats. It's crucial to remember that these protections have limitations. The coverage amounts we mentioned, $1 million for CIPF and $100,000 for CDIC, are maximums. The actual amount you recover depends on the total value of all eligible accounts you hold with the respective member institutions. Furthermore, these protections extend only to registered accounts. If you have any unregistered investments held with Wealthsimple, those might not be covered. It's always wise to double-check with Wealthsimple or the relevant protection agency for the specifics of your situation. The bottom line: while the possibility of Wealthsimple going out of business might seem scary, the presence of CIPF and CDIC offers significant peace of mind. These government-backed programs act as safety nets, ensuring your investments and cash are to a large extent protected. However, understanding the limitations and diversifying your accounts across different institutions can provide additional security. Remember, knowledge is power. By familiarizing yourself with these safeguards, you can invest with greater confidence, knowing there are measures in place to protect your financial future. With that said, thanks for watching, and until next time.